Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So what will be our today's topic, Nick?
All right, so we've got a great topic for today. We're going to be talking about shorting companies and what a short squeeze is, and we're going to give some examples. Most investors, even beginner investors, understand the concept of finding a company, buying it, and then waiting for that company to increase in value, waiting for the stock price to go up, and then selling, and that's your profit. So betting on a company to go up is the one way of making money that is the most understandable intuitively. We all understand it. But now, what if you find a company that you think the opposite? You think this company is going to go down. This is a horrible company and it's not going to last. It's probably going to go bankrupt. The stock price is definitely going down. How do you make money from that knowledge? And that's what shorting is. It's the opposite of going long. And going long just means that you're hoping it'll go up. And going short means you're hoping it's going to go down. How it works on a technical level is fairly easy to explain. A lot of people have trouble wrapping their brains around it, but when you have it explained really simply, it makes sense. Let's say I have a brand new soccer ball. Let's do something more expensive. Let's say I've got a PlayStation that I've purchased, and you come to my house and you say, I will borrow this PlayStation for you. It's brand new. You're going to borrow it from me. You'll return to me a sealed PlayStation in 3 months' time. And I say, no problem, but I want $40 for you borrowing this PlayStation. And you say, no problem. So you take the PlayStation and you go and sell it tomorrow for the current price that it's available at. And then you've just made, let's just say, I don't know how much PlayStations are, say $300. 3 months later, you owe me a PlayStation in the box, still sealed, so you go and buy one. Maybe you bought it for $200 because time has passed, PlayStations aren't worth as much. The price has gone down. So you buy it for $200, you give it back to me, still sealed, and I'm happy. I made $40. I still have the sealed PlayStation, and you've made an extra $60 because of the difference of the price going down. And effectively, shorting is the same thing. You're borrowing stock from somebody with the promise of giving them the same amount of stock back at a later date. You sell the stock immediately, and then when the price goes down, you buy it and you give the stock back. The problems with that is that potentially you could lose. If the stock goes up, you're going to have to buy it at that higher price. And because of the nature of it, there is no limit to the amount of loss that you can make. If you buy a stock at $20 and you expect it to go down to $2, and for some reason that stock goes up to $200, now you're losing 10 times the amount of what you purchased. There's no limit to how high a stock can go. You don't know the reasons that the stock market moves the way it does. All it takes is a bit of hype, a new product, someone coming in to acquire it. The stock price could go really high. But in essence, that's how shorting works, is that you buy it, you borrow it, you sell it immediately, and you buy it later to give it back. And if you are certain the company's going to go down, that's where the profit lies. I don't recommend it at all, ever, under any circumstances. And yet that's how shorting works. Over to you, Eugene.
Yeah, you described really well the example with shorting and buying stocks, expecting that the company will go down. And I would like to add that in most cases, the broker doesn't wait for you to lose 10 times more money, which you already borrowed. He would just call back the shares and your order after it will hit like 2 times or 3 times. So you initially will lose all of your money. And on the other hand, if you would like to make any money by shorting, the maximum which you can receive is 2x. So on the one hand, you can lose everything, and on the other hand, you can make just 2x, and the downside is unlimited. So now let's understand why this situation can actually occur and why most people just try to short this stock and why they think that this company can be really doing bad and all this stuff. So first of all, it's like unpleasant economic events or economic downturn. So for example, there was the situation with the company in different spheres like AMC. So you probably heard about that. So this is the industry which is going down due to the online streaming services like Netflix, Roku, etc. As a result, most people just go less in theaters and watch movies less. So in this case, the company is earning less, and the audience and the stock market thinks that the revenues will drop after a certain period of time, and they want to make money on that. So what they do, they short the stock.
I think that there's a lot of indicators that have been trusted by short sellers to indicate perhaps a good company to short. Two of them, for example, would be looking at the PEG ratio, that's the price to earnings plus growth ratio of small cap stocks. So typically, using that ratio, many people would say that a PEG ratio of 1 is a fair price. If it's under 1, it's undervalued. If it's above 1, it's overvalued. So short sellers would look at a PEG ratio of maybe 1.7 upwards and go, it's so overvalued, it has to come down. This is a company I'm going to short. Other people will look at the health and the finances, huge debt, that kind of thing. Perhaps looking at the Altman Z score, which is a score that has proven itself pretty interestingly to predict bankruptcy within 2 to 3 years with an 80% accuracy. If the score shows above a certain number, the chances of it going bankrupt is very, very high. And so when you short a company that goes bankrupt, you don't have to pay it back. If it goes bankrupt, you literally don't have to return those shares to the person because those shares don't exist anymore. They're worth nothing. And so you got all of it for free. It sounds wonderful, but there's huge risks. Back to you.
Most of these strategies are not considered doing at all, and they are not recommended to do at any time. And they're connected with a huge risk. It's not the value investing, it's not the long-term investing at all. And that actually brings us to the situation which is called short squeezes. And the main reason why this can happen is that by unknown circumstances, the stock of the company is going up. And this company shouldn't be in the better position by recent years, or it hasn't done anything much in revenues or net income, but the stock continues to increase. And this brings the situation when some people really understand that this is the crappy business and they started shorting it. So in this case, this situation is called short squeeze because usually this pumping up the price of the stock won't take so much long, and eventually the stock will drop down. So what do you think about that, Nick?
Yeah. Short squeeze is a horrible thing to experience if you're the guy doing the shorting, because now you're being squeezed. So you've shorted the stock, you have to pay it back, and the price is going up. And you know that at some point you will be forced by your brokers or agreements, no matter what you do, and there might be ways of extending your shorts or shorting deeper to try and offset losses. No matter what you do, you're being squeezed. The higher that price gets, the worse it gets. And you know you need to cut your losses. Horrible experience. And yet that's exactly what happened with GameStop. The guys on that Reddit channel did some calculations. They figured out that GameStop was over shorted. It was shorted ridiculously. There should be a limit to how much you can short a company. But in fact, if you were to short all of the shares of all of GameStop and then short them again, so that's the kind of thing that was happening. You shouldn't be able to borrow more shares than there are in existence, but that's what was happening. And the guys realized that the price was so low that with very little effort, they could push the price upwards just by buying and holding. And more people would buy and hold. And that's where the term diamond hands comes from. It means you're just going to sit on it. You're just going to hold it and let it go up. And that's what they did. And more and more people got involved. And when it hit the newspapers, more people got involved. And that price shot right up. And a lot of institutions who were shorting, a lot of hedge funds that were shorting, lost, some of them even lost the majority of their money. Sitting on $1 billion in investing money and shorting GameStop was such a mistake because some of them lost over 50% of their entire portfolio worth because they had to cover that loss. Remember, when you short, the best you can do is you can double your money. If the stock goes to zero, the amount you purchased at, you're effectively, or the amount you borrowed at, you're effectively doubling your money. But there's an unlimited loss potential.
Yeah, this is a really crazy thing. And actually, in the latest days, this situation repeats and repeats. And usually the main reason why it's happening, because in most cases, when this situation occurs and the stock price increases, this and starts like the chain reaction, because immediately the websites of the news portals and news channels start telling about that. Then the YouTube bloggers and other bloggers in TikTok or different social networks continue to improve and increase the hype. And eventually, more and more people become familiar with this news, and some of them start buying or shorting the stock. But anyway, this is not the best way to do, and we do not recommend that at all. I think personally that you need to consider and you need to sometimes look about the ideas from the different point of the table in order to understand why these people particularly short this stock. So usually when you try to invest in the company and you try to hold this stock for a long term, you need to know why this business can go wrong and what can go wrong in order for you to lose the money. So in this case, I think that analytics and ideas about shorting, if they are really presented in a clever way, are really useful.
Two more points on shorting that'll be my final points is number one, one of the reasons that people might do this GameStop type of action, buying the stock and holding it, is that you know that the people doing the shorting will be forced to buy the stock. And if you don't sell, it means the price will go up when they buy the stock that they have to pay back. And that pushes the price higher, and that allows you to sell at a higher price. And so there's kind of almost a guaranteed growth in the stock, and that's kind of the idea behind the technique. And then the second point is the dangers of doing diamond hands, of doing a short squeeze, of being part of a movement that damages the people doing the squeezing. Firstly, the two downsides of it. One, you might laugh at these hedge funds that you've damaged. Oh, they lost half their money. They shouldn't have been shorting this company. So on the one side of it is you're not actually damaging the hedge funds. You're damaging the people who have invested their life savings with the hedge funds. Some of those people who have invested in those companies are teachers with their retirements. And so don't laugh at the lost money that you've caused by doing diamond hands. You may have damaged people that you wouldn't have wanted to damage. And on the other side of it, there are risks to you, the guy with diamond hands. You now own a large amount of a company that is trash. I'm not saying GameStop in specific is trash, but I'm saying there's a reason that a lot of these companies are being shorted. And if you choose a company that is terrible and you're buying stock in it, you're paying a price that is too high at the time that you're going in for the value of the company, and you may hold on too long, and you will be the one that loses a lot of money when the price catches up to the value. it will go down. And a lot of the people who were involved in the GameStop thing and didn't profit, they lost a lot of money. It's just like buying any other meme stock. Yes, you can ride it on the way up, but if you wait too long, if you don't time it right, we don't do timing as real investors. We don't try and time the ups and downs. But if you get in too late and you get out, too late, you're going to lose a lot of money. So this is not a safe way of investing, and definitely things to be considered. And that's me done with what I have to say about shorting. Over to you.
That's why we try to educate as many people as we can by recording this video in order to be intelligent investors and understand investing, business, and finance better. But anyway, this is all for today. We hope you really enjoyed this episode. If you have any questions, please write them down in the comments below, and see you next time.